All right, let's talk about one of the most powerful and honestly one of the most misused indicators out there, the Commodity Channel Index, or CCI. You see, a lot of traders think they have this one figured out, but they keep falling for the same very expensive trap. So let's just cut right to the chase with a huge question. Is this thing actually a money trap? And you know what? For a ton of people who use it the textbook way, the answer is a big fat yes. They see that overbought signal and they hit sell. Or they see oversold and they jump into buy, and that's exactly where it all goes wrong.
And this right here, this quote is the whole problem in a nutshell. When a stock or a coin is in a really strong uptrend, the CCI can be screaming overbought by staying way above that plus 100 line for days, maybe even weeks. Anyone selling based on that signal is basically trying to stop a freight train with their bare hands.
So let's give this mistake a name. We'll call it the common CCI trap. It's this simple but totally flawed idea that just because the indicator goes above plus 100, the price is about to crash. But here's the first big mind-blowing moment for a lot of traders. In a strong trend, a CCI reading over plus 100 isn't a sell signal. It's often a sign of incredible strength.
So what's the big takeaway here? When you just blindly sell at plus 100 or buy at minus 100, you're not being a clever trader. You are literally fighting the market's momentum. It's a recipe for a ton of false signals, and it's probably the fastest way to bleed an account dry when a market is trending hard.
Okay, so to get out of this trap, we have to really get what the CCI is actually built to do. It's not just some simple reversal signal. We need to look under the hood and figure out what those lines are really telling us.
Okay, so here's the thing. The CCI doesn't really measure overbought or oversold. What it actually measures is deviation. It's basically asking one simple question. How far away is the price right now from its recent average? So a really high reading just means, wow, prices are way higher than usual, which, if you think about it, is exactly what happens in a strong uptrend.
Now, you don't need to be a math whiz to get this, I promise. This is pretty much how the indicator thinks. First, it figures out the average or typical price over a certain number of candles. Step 2, it looks at the current price and measures how far it's strayed from that average. And third, it standardizes that number so we get this nice little oscillator that moves up and down. Now, this is where it gets really interesting, especially when you compare it to another indicator like the RSI. You see, the RSI is bounded. It's stuck in a box between 0 and 100. But the CCI, it's unbounded. It has no roof and no floor. It can shoot up to plus 200, plus 300, whatever. And that one difference is everything. It's what allows the CCI to show you not just that there's momentum, but just how crazy strong that momentum really is.
So if just trading those overbought and oversold levels is a trap, what did the pros do? Well, they hunt for something way more powerful, way more subtle. They look for divergence. And this is how you unlock the real magic of the CCI.
Think of divergence as an early warning system. It happens when the price chart is telling you one thing, but the indicator down below is telling you a completely different story. It's like a secret signal that the momentum driving the trend is getting tired, often way before the price itself decides to turn around. And this table breaks it down perfectly. Let's look at the red row for a bearish signal. The price is making higher highs, right? But at the same time, the CCI is making lower highs. They're moving in opposite directions. That's your divergence. And for a bullish signal, it's the reverse. The price is hitting lower lows, but the CCI is starting to curve up, making higher lows. That tells you the sellers are losing steam. Let's really drill down on a bearish example. So on your price chart, everything looks great. The price just made a new higher high. But then you glance down at your CCI and you see that it failed to make a new high. It's actually lower than its previous peak. That disagreement, that disconnect, that's your warning sign that the upward push is running out of gas. And here's the flip side, the bullish setup. The price chart looks awful. It just dropped to a scary new low. But check out the CCI. While the price was falling, the CCI put in a higher low. What that's telling you is that even though the price is down, the actual selling pressure, the momentum, is fading fast. A reversal could be right around the corner.
Okay, but hold on. Even with a signal as powerful as divergence, there is one golden rule you absolutely cannot break. I'm talking about the rule of confirmation.
And there it is, plain and simple. The CCI is an amazing tool, but it is not a crystal ball. A divergence is a massive clue, but it's not a guarantee. The absolute best, highest probability trades happen when you have multiple signals all pointing in the same direction. We call that confluence.
So you need to build a little mental checklist. As soon as you spot that CCI divergence, start hunting for other clues. First, what's the overall market structure? Is it trending or just chopping sideways? Next, look for a specific price action signal, like a big, powerful engulfing candle. Did a key trend line just snap? And is all of this happening at a major support or resistance zone? The more of these you can check off, the better your odds.
All right, let's get even more hands-on. Because you know what? That default setting on your indicator isn't always going to be the best for you and your style. You can, and you absolutely should, tweak the CCI to fit how you trade.
So most trading platforms will set the CCI to a 20-period setting right out of the box. And that's fine. It's a decent all-around setting for a swing trader, but it is definitely not a one-size-fits-all solution. If you're a scalper, you need something way faster. If you're a long-term investor, you need something way slower.
This little table is a fantastic place to start. If you're scalping on those super short time frames, try a much quicker setting, somewhere between 5 and 10. For most of us doing swing trading, that standard 14 to 20 range is really the sweet spot. And for the long-term position traders out there, you'll want to slow it down with a setting of 30 or even higher to just focus on those major market shifts.
So after all that, what's the final verdict on the CCI? Is it a hero or a villain? Well, let's wrap it all up.
Look, the CCI is a fantastic and super versatile indicator. The way it spots extreme momentum and, most importantly, divergence is a huge pro. But yeah, it's got its downsides. It's still based on past data, so it's a lagging indicator, and in those really messy, sideways markets, it can throw out a lot of confusing signals. Which brings us back to the main point. It absolutely needs confirmation from other tools.
And hey, if you only remember one number from all of this, let it be 20. It's that classic default setting, and it's the perfect place for most people to start. Get really good at reading how the CCI works with a 20-period setting, and then you can start tinkering with it to match your own style.
So I'll leave you with this final thought. At the end of the day, the CCI is a momentum indicator. Its whole job is to show you the power and direction of the market's current. So the real question is, are you going to use it to help you catch the next big wave? Or are you going to keep using it to try and fight against the tide? The choice is yours.